First off, in order to better follow along with this video, I'd like to suggest that you watch this video in full screen mode as the text of the document is relatively small and full screen mode makes the document easier to read. The HUD-1 is a standardized form provided by the closing agent, such as an escrow company or real estate attorney, at least one day prior to the closing of the mortgage that lists the final, actual terms and costs of a mortgage, including the interest rate, points, and all one-time expenses. Typically, the borrower receives an estimated HUD-1 when he or she signs loan documents 3 to 4 days prior to closing. The main purpose of the HUD-1 is to make sure that the key terms of the mortgage you actually receive at closing match the terms that the lender committed to providing at the beginning of the process, so there is no bait and switch by the lender. The last page of the HUD-1 compares the final mortgage terms to the estimated mortgage terms as outlined in the good faith estimate document the lender provides to the borrower at the beginning of the process when the borrower submits a loan application. In this example, we show a scenario where the final terms of the mortgage as outlined in the HUD-1 match the estimated terms as outlined in the good faith estimate, but always be sure to review the HUD-1 carefully before finalizing your mortgage. I'm going to walk through an example HUD-1 for a home purchase mortgage now. In this example, our buyer is purchasing a $475,000 property with a $95,000 down payment and a $380,000 30-year fixed-rate mortgage with a 4.250% interest rate. The first page of the HUD-1 summarizes the transaction from both the buyer's perspective and the seller's perspective. The buyer's information is presented on the left side of the page, and the seller's information is presented on the right side of the page. I'm going to focus on the buyer in this case because that is the person obtaining the mortgage. The purpose of this rectangle is to show how much money the borrower has to pay to close the mortgage and purchase the property. The first line shows the property sales price, or $475,000 in this example. The next item to focus on is settlement charges, which are the one-time closing costs the borrower is required to pay. Our one-time closing costs are approximately $5,560 in this example. We will review a breakdown of these costs on page 2 of the HUD-1. The next category is adjustment for items paid by the seller in advance. This typically has to do with property taxes that the seller has already paid for. For example, the seller may have paid property tax for a 6-month period, but sells the house within 3 months. So there's an adjustment for the period of time when the seller does not own the property. When you add these figures up, the purchase price, settlement costs, and the adjustment, you get the gross amount due from the borrower, or the amount of money the borrower has to come up with to buy the property. Next, we have the amount paid by or in behalf of the borrower. Simply put, this is the amount of our mortgage, so $380,000 in this case, plus any initial deposit or earnest money the buyer has paid when they agree to buy the property, which is $5,000 in this example. The next category is adjustments for items unpaid by the seller. In this case, the buyer has to pay prorated property taxes depending on when the mortgage closes and when property taxes due. If you add these figures up, the mortgage amount, deposit, and property tax adjustment, you get the amount of money paid by the borrower, including the mortgage amount. At the bottom of the table, you see this figure is subtracted from the gross amount due from borrower at the top of the table to calculate the amount of money due from the borrower at closing, which is approximately $93,000 in this case. The amount of money due from the borrower at closing represents the remainder of our down payment plus certain settlement or closing costs. In this example, our down payment is $95,000, $5,000 of which we have already paid with our initial deposit or earnest money, so we owe the remaining $90,000 at closing, plus we are required to pay the remainder of our closing costs. Page 2 of the HUD-1 provides a detailed breakdown of our settlement charges, also known as closing costs. The first category is total real estate or broker fees. This is the commission paid to the buyers and sellers real estate agents. Please note that real estate agent commissions are almost always paid for by the seller and not the buyer, as indicated in this example. The next category is items payable in connection with the loan. These are the one-time upfront closing costs that we are required to pay to the lender or other third-party service providers. First, we have the origination charges, which are the fees charged by the lender to process and close your mortgage. Different lenders use different terminology for their fees, and sometimes you see terms such as origination points, underwriting fee, commitment fee, funding fee, or administration fee. These are all different ways to describe lender fees. This is also the section where you would see the charge for any discount points you decide to pay. A discount point is an upfront fee equal to 1% of your mortgage amount that borrowers have the option to pay to lower their interest rate. In this example, we are not paying any discount points, so the figure is blank, and we show total adjusted origination charges of $1,070. Next, we have other non-lender closing costs the borrower is required to pay at closing. These 4 items are services that the lender typically selects and bills the borrower for but then pays third parties to perform these services. First, we have the fee for the appraisal report, which is an assessment of the value of the property we are buying provided by an independent appraiser. Next is the credit report fee, which is a fee to pull a copy of your credit report. The tax service fee is a fee to set up an account with the tax service company so the lender can make sure you pay your property taxes. The flood certification fee is a fee to make sure that the property is not located in a floodplain. There may be additional fees for additional reports required by the lender, but this gives you an overview of some of the more common ones. The next category is items that the lender requires the borrower to pay in advance that the borrower will continue to pay after the mortgage closes. First, we have daily interest charges. As part of your closing costs, you're required to pay the lender interest charges from the day your mortgage closes until the end of the month in which your mortgage closes. In this case, we show our mortgage closing on the 15th, so we are required to pay interest for 16 days. Next, we have the cost for homeowners insurance, which is also known as hazard insurance, which is insurance against significant property damage, such as from a fire. Borrowers are required to purchase homeowners insurance when they get a mortgage. The borrower can choose the insurance company and policy as long as the policy meets the lender's requirements. In this case, we're buying a 1-year insurance policy for $475. Depending on your loan-to-value ratio, which is the ratio of the amount of your mortgage to the value of the property you are buying and what type of mortgage program you select, you may also be required to pay mortgage insurance to protect the lender in case of default. Also, depending on where your property is located, you may be required to purchase flood insurance. Although these items do not apply to our example, both would be listed in this category if applicable. The next category is reserves deposited with lender. Depending on your loan-to-value ratio, your lender may require that you pay for certain items such as property tax, homeowners insurance, and mortgage insurance on a monthly basis into an escrow or impound account along with your monthly mortgage payment. In this example, we are not required to have an impound or escrow account, so we leave the figures blank. The next category is title charges. The first item is lender's title insurance. In most cases, the buyer is required to pay for title insurance for the lender to make sure that there are no exceptions or issues with the property's title, the legal document that records the property's ownership, that could interfere with the buyer's ability to finance the property. Next, we have settlement or closing fee, which is the fee charged by a closing agent, such as an escrow company or real estate attorney, to process and close your mortgage. Escrow companies are typically used in the western U.S., and real estate attorneys are typically used in the eastern U.S. The buyer also receives title insurance, which is typically paid for by the seller. The notary fee is charged by a notary hired to notarize your mortgage documents. Next, we have the government recording and transfer charges, which are the fees charged by your local government when a property is sold. We show a $150 recording fee in this example. Most local governments also charge a fee or transfer tax when a property is sold. These fees can be significant, but they are typically paid for by the seller, so we have left that figure blank. The final category of closing costs is additional settlement charges. These are the fees for services that borrowers elect to have done that are not required by the lender. In this example, we show fees for pests and property inspections to make sure that there are no significant issues with the property, such as termites or structural issues. Although these inspections are optional for the borrower, they are highly recommended when you purchase a home. At the bottom of the table, we have the total settlement charges or closing costs the borrower is required to pay. So approximately $5,560 in this example. The table on the top of page 3 of the HUD-1 compares the actual final terms of your mortgage to the terms outlined in the good faith estimate the lender provides to the borrower at the beginning of the process. The table notes if and by how much the cost can change according to lending laws. As shown in the first table, the origination charges or lending fees cannot change. The second table shows that non-lender costs, such as the appraisal and title insurance fees, cannot increase by more than 10%. The third table shows the charges that can increase without a limit as compared to the good faith estimate. The final amount for these items, such as the daily interest charges, typically depend on the date your mortgage closes, which can be difficult to predict at the beginning of the process. There are typically minor differences between the estimated figures provided in the good faith estimate and the final figures provided in the HUD-1. However, if the difference between the figures is significant and the final costs have increased significantly, you should definitely ask the lender for an explanation. If you're not satisfied with the explanation, then you should cancel the mortgage. You can cancel your mortgage at any time before it closes, and you are free to work with a different lender. Although you may be out non-refundable costs such as your appraisal fee and certain lender fees, canceling a bad mortgage will save you much more money over the life of the mortgage. The bottom of page 3 of the HUD-1 summarizes key mortgage terms, including mortgage amount, interest rate, and monthly payment. This table also reviews the key features of the mortgage, such as if the interest rate, mortgage balance, and monthly payment can increase, and if a mortgage has a prepayment penalty or a balloon payment. Because we're looking at a fixed rate mortgage with no prepayment penalty in this example, the answer to all these questions is no. The final item indicates that the borrower needs to pay for items such as property tax and homeowners insurance into an escrow account every month. along with their mortgage payment. This is also known as an impound account. Lenders require an impound account in cases where the loan-to-value ratio, or the ratio of the amount of the mortgage to the value of the property you are buying, is greater than 90%. Government-sponsored mortgage programs such as FHA and VA loans also require an impound account. In this case, the borrower will make these payments directly when due, so the box for no is checked. That brings us to the end of our example HUD-1. We encourage you to review related freeandclear.com videos, such as our good faith estimate, truth in lending statement, and lender fees worksheet overviews, as well as the home purchase mortgage process guide on freeandclear.com. Thank you for reviewing the HUD-1 overview with freeandclear.com. freeandclear.com.